The gold price is going down. You're at 58 now on silver. You're sub 60. What I'm going to draw is just remind everybody, because it's when everyone's all doomer that they need reminding of the big picture. We still see in the years to come you'll be running $333 and going higher. We haven't changed any of our opinions. You're broken 4,000 is not the end of the world. We talk about three big sell-offs. You made your first impulse here. That's your first impulse, this whole upward move and down into that localized low at 4,000, and we think you're making a second impulse with a low still to be found. Gold is continuing down, and that's going to lean on silver too. So we don't think the next month or two is going to be particularly positive for gold. We would say you're going to have as much opportunities if you're a technical short time frame trader trading it short. I don't sell silver, I replaced it. If I have to just reorganize it, I only add. So it's an accumulate season for investors. I'm happier shorting the oil price. I just want everyone to bear in mind that that's actually very good for miners. Even though the gold price is going down, it's very good for miners that we are getting a drop in the energy prices. So here is gold. And one thing I want to do is when things get confusing and there's a pullback is extending, it's a very good idea to go up to the higher time frames. I've annotated this chart quite a lot already. Let me just remove that number for now and remove that in the neckline. So we were looking at the wash period and thinking that we were all expecting a no increase. Again, when I say that was all being expected, it's kind of interesting that everybody automatically expected that, because again, you're well above your rates. We've drawn this kind of channel, and you may find the channel probably runs something like that. Let me just correct that and extend some of the lines. You may find you make it to the bottom end of that channel, which could be, in the 3,000s over here. By the way, let's just remind everybody on this channel, we said 2,000 breakout in 2024 that you were going to run 3,000. You did. You got multiple setups. You continued to run 3,000 and eventually overshot to 5,600. So a run back to the mid 3.8s or 3,800 or just below 4, which you've already done, by the way, you've broken 4,000, is not the end of the world. We talk about three big sell-offs. And when I go up to the bigger time frame, I'm looking at this now and saying, well, here's your major trend.
The market celebrates lower energy costs, while quietly ignoring what that means for mining margins during a gold correction. Francis Hunt notes that a retreat toward major channel support does not invalidate the broader bull trend many investors spent months chasing. The contradiction is that bearish sentiment is rising precisely as producer economics improve beneath the surface. For wealth preservation investors, trend structure matters more than headline volatility. Next, Francis Hunt exposes why consensus expectations around rates may be masking a much larger technical reset.
And I'm doing away with this shooting star flash and the hammer, because it was negated and you came back on trend. More and more, when we look at what we call the slap in the face, the real sell-off started here where you couldn't. This one was very quickly brought back into the range. So we talk about three major sell-offs. We're extending that with the price behavior. And I think you made your first impulse here. So I'll just draw that. That's your first impulse, this whole upward move and down into that localized low at 4,000. And we think you're making a second impulse with a low still to be found on the weekly time frame. And we expect three, so you'll probably have some form of a rally and then a third sell-off, usually the weakest. And then you will start to be in a situation where we might start thinking of reversals. So gold is continuing down, and that's going to lean on silver too. But before I drag you into silver, let me hand back to you. Is there anything on that you want to come back at me on?
No, I think we're all seeing the sell-offs for various reasons why there are sell-offs going on. But I think the question I'm getting now is there a floor? What might the floor be?
So technically, this is a medium to reasonably long pullback period after a blow-off event, a blow-off momentum event. The floor by price is a difficult call for me. Typically, we would look for a technical pattern which had a sort of a downside.
This happened repeatedly in prior commodity cycles. The second decline lasted longer than investors expected and inflicted the most psychological damage. According to Francis Hunt, current price action resembles a multi-stage correction rather than a completed washout. The overlooked signal is not the size of the drop, but the sequence, because institutional money often accumulates before the final, weak-handed sellers exit. For savers relying on precious metals as insurance, timing mistakes can feel worse than valuation mistakes. Next, Francis Hahn reveals why searching for an exact floor may distract investors from the real reversal signal.
Rather than getting a technical pattern, we're just seeing this pullback in the channel, as I'm illustrating here. Quite usually, if you've drawn the channel correctly, you'll probably meet the lower basing descending grind line, which I'm drawing in gray here, at some point. Depending how fast you do it, it will depend the value. And we don't think that's going to be the final. We think you'll go up and over one more time. That was the point I'm making. Although the third sell-off is usually the smallest. So I'd say the first, if we're treating this as the first, which is our personal new view, was pretty violent. This one is grindy and painful and never-ending by time frame. So if you look at the duration, it's very typical of second impulses in selling. We call them bloated and lengthy. You can see the time frame that's been going on. The first one started probably here and ended there. You did get some volatility here, we know that, but the general trend was brought back up. So you can see the time duration. It's a more hurtful one, the second one, because it just doesn't get done. It just keeps coming at you. This was violent, but very violent in that candle. So our expectation is you'll have some sort of localized low and another up, and you'll still have a third sell-off before you're likely to break out the channel. So we don't think the next month or two is going to be particularly positive for gold. We would say you're going to have as much opportunities if you're a technical short time frame trader trading it short. Not something I'm interested in doing, but some people that are low time frames could be making profits as traders.
The most dangerous corrections are not the sharp ones. They are the slow declines that convince investors nothing will ever recover. What Francis Hunt is highlighting is a classic second leg correction, where time, not price, inflicts the deepest damage on sentiment. Most market participants focus on volatility spikes, yet prolonged weakness often creates the best long-term accumulation opportunities. Investors protecting purchasing power should recognize that exhaustion usually arrives before optimism returns. Next, Francis Hunt unravels why a final sell-off could become the setup bullish investors have been waiting for.
In terms of buying and investing, you're going to get, these are very good accumulation points, and we're in the blue pot thinking. I only look on the long side on gold. I think that will be a good entry to buy gold and or silver, and wherever that low comes in, it'll be a good entry, and I would expect that close to being the final, and then you'll recover, but you won't go straight to a melt up. You'll recover with ups and downs and churns and grinds, to the upside, and before eventually making new highs. In terms of our bull expectations, particularly where we've given numbers on silver, we still see that in the years to come, you'll be running $333 and going higher. So on the big time frame, we haven't changed any of our opinions. This is just a longer pullback than most people expected.
Yeah, I agree with that. Appreciate the honesty there. I think that's what a lot of people are looking for right now. But same question with silver. You touched on it, and a lot of people are wondering what's happening with the silver price, considering supply and demand. We're still in a supply deficit, and are the fundamentals still in play, or are they not? And lastly, I was going to ask you, are we going to head back down into the $50 range for silver? But that has also been answered.
Yes, you're at 58 now on silver. So you're sub 60. What I'm going to draw is just remind everybody, because it's when everyone's all doomer that they need reminding of the big picture. And I'm quite happy to be the one to do that.
When fear dominates the conversation, investors often forget that wealth is built during corrections, not euphoric breakouts. Francis Hunt's argument suggests the bigger trend remains intact even if silver and gold spend months frustrating both bulls and bears. The real disconnect is that supply deficits still exist, while many investors behave as though the long-term thesis has collapsed. For retirement-focused savers, temporary weakness can matter far less than maintaining exposure to scarce assets. Next, Francis Hunt exposes why silver's current decline may be hiding a much larger structural imbalance.
Because it's easy, and it's something I have very little doubts about. The greater the time frame you go up, the more conviction you can have on those things. So just to remind everybody, the upside, this is an upside HVF of many years standing. I call it, the trade of my life, because it's essentially started in 68. You're talking way back here, 67, 68, started a move that began the run up to that high that was the 80s. And I was still a schoolboy, obviously, in the 80s. And we warned everybody. And this is again, it sounds a bit salesy. I apologize for this. The one unique thing about Hunt Volatility Funnel method is, instead of just giving you a final target, a stop loss, and an entry point, it also tells you when you could expect on your journey path pullbacks. Smart people realize price behavior does not go up in a straight line, even in breakouts. This is a breakout trade. We got a squeeze within a squeeze. Brent Johnson was here calling, it's crazy, all the silver guys getting excited about 25 again. It turned out the triggering event candle there for the primer. It turned out the major triggering event. And then we charged up and we ran our second interim. What happens at a second interim is you go into progress decay for a while, which means no longer going up, time passes, and you go down. And here you have a huge shooting star on the 6-month time frame. In fact, it's extending. When I did a YouTube on this and that body was smaller, now it's even extended a little bit. It's almost not so much a shooting star because the candle body is starting to get longer, it's getting lower.
Markets rarely move in straight lines, yet retail investors keep expecting permanent momentum after every breakout. This is where Francis Hunt's thesis shifts from price targets to market structure and timing. The overlooked signal is the 6-month rejection pattern developing after an extraordinary advance, something institutions often monitor long before financial media notices. Investors focused only on upside projections can miss the warning embedded in momentum deterioration. Next, Francis Hunt reveals why this long-term rejection candle may matter more than any daily headline.
And the 6-month is all but done. So January the 1st, right the way through to the last day of June is going to be around Tuesday next week, trading days. So you've got today, Thursday, Friday, and Monday and Tuesday of a 6-month period. We're literally done, and it's going down during this period. That is a major rejection and sell-off after running the second interim. We got the leverage long traders that we put in for this explosion upside to our second interim out at $118. We even, when we gave a tweet out to people who are followers for free, it was $111. That was on the last day of January before I went off to ride motorcycles. So that was probably the last best time to have got out. Talking about leverage trading. I don't sell silver. I literally, because I moved location, sold one stash and replaced it in another location because I wanted to divest fully from the United Kingdom because of unrealized capital gains and tax scavenge mode being enacted by the governments in the West. But apart from that, I don't sell silver. I replace it. If I have to just reorganize it, I only add. So this will go down, and I am totally, most of the silver I've bought has been at the 13, 14, 15, 20, 25, 28, 29, even paying that in the UK up to $30. And I'm not concerned that we're 58 at the moment. It's double probably the most expensive price I paid from 3 years ago. And it's only the most recent investments I've done in the last year or two that you might find that you're heading towards potentially being underwater.
A market can decline sharply and still leave long-term holders sitting on substantial gains, which is why panic often benefits stronger hands. Francis Hunt notes that leveraged traders and physical accumulators operate under completely different risk frameworks. The contradiction is that short-term price weakness gets treated as failure, while long-term purchasing power trends remain largely intact. Investors who confuse speculation with wealth preservation often sell precisely when conviction should be highest. Next, Francis Hunt exposes the critical difference between temporary drawdowns and a broken precious metals thesis.
And given enough time, those will be back in the blue and you'll be smiling again. So it's an accumulate season for investors. Right now, if you're a tactical trader, it's even a short if you want to short it. I'm happier shorting the oil price, and I'll be ready to catch. I'm already short MicroStrategy and other things that are probably more fluffy price. Your question was about the fundamentals. Those things will be rearing their head again, and these things will turn sooner. One of the many reasons why I'm less interested in a short on this when I have a hyper-valued stock market to take pick of any number of unbelievably fluffy priced assets that I consider incredibly tenuous and far less credible than silver or gold. So I just highlight that. That's a rejection candle. And by the way, the next 6 months, you're probably not ripping into a green candle when you're coming out of this. There's too much downside momentum. What was the one-word answer I gave you? I refer you back. This is indicative of distress. So you quite possibly go lower, and the best way is you get another hammer with a downside wick, and then you reject back up. So we could have a crash, we go a little bit further down, but eventually we find an absolute hard floor where the miners aren't interested anymore in selling their silver. Guess what happens? It's harder to accumulate, the shortage starts to come, the fiat currency is debasing again, you're going to have bond rates up, etc., etc. Lots of other things. People don't want to own bonds, they go back to buying metals, and you'll start to see that reflate. I just think there's a bit of liquidation stress at the moment, and the one thing anybody will happily take off you is your gold and silver and buy.
Do we see a floor anytime soon for platinum?
It's a very interesting one. I like the white metals. White metals matter, I say.
Investors are obsessing over falling metals prices while ignoring how overstretched many financial assets remain. According to Francis Hunt, distressed conditions can create further downside before fundamental shortages eventually reassert themselves. The deeper issue is that liquidity events often force selling in quality assets first, even when underlying supply remains constrained. For portfolio protection, distinguishing temporary liquidation from permanent impairment is absolutely critical. Next, Francis Hunt reveals why future shortages could emerge just as confidence in traditional financial assets begins to crack.
Part stirring mischief and part because it's actually what I fundamentally believe. There's a lot of gold that can be at certain prices get stored. But if I open the same chart for you, you can see a massive rejection candle here. I would say worse than the silver rejection initially, but this is on incredibly light volume. The ability to access platinum at the moment in any massive volume is limited. So this paper price, it's only because I would imagine demand is fairly moderate that you're not having a crisis here. This metal will go unobtainium in a certain time, and I do think if they'd ever go confiscation becomes a threat, on, say, silver, especially gold, where people hoard gold. I don't think platinum is as easily captured in that. People don't even know it. Governments don't even understand it. They don't expect many people. If you think retail stackers are small compared to central banks and institutions in the gold market, let me tell you, retail stackers in platinum, I don't even think they'd bother to come after you for platinum. I really don't. So I personally have quite a soft spot for it. And I think it's going to be giving an incredible opportunity for people to accumulate physical. But good luck trying to buy it in huge volume or without, and also not paying some quite extensive premiums on real price. So I think it's an accumulate in this market. I think it's very cheap, but that doesn't mean it's not going to get tiny bit cheaper still on the back of that.
The smallest markets often become the biggest surprises because institutions cannot easily scale into them once demand arrives. What Francis Hunt is highlighting is the growing disconnect between platinum's paper price and its limited physical availability. The official pricing mechanisms suggest calm conditions, yet tight access and thin liquidity tell a very different story beneath the surface. Investors seeking overlooked hard assets should pay attention when scarcity exists before public interest appears. Next, Francis Hunt unravels why platinum's quiet market may conceal one of the most explosive supply stories ahead.